Janice Seiler needed a truck. Her household already carried one car payment for $36 a month, but she needed reliable transportation. The dealership offered financing. The bank ran the numbers. They said yes. For the next 6 years, the Seilers owed $750 a month. On top of that, the interest rate on Janice's loan 22.05%, more than 3 times what a borrower with good credit pays for the same vehicle. The loan filing showed Janice qualified based on an income of around $70,000 a year. The Seilers say they never made that much. She signed because the bank said yes. She assumed the bank said yes because they believed she could pay it back. That assumption was wrong, not because the bank made a mistake, because by the time Janice drove off the lot, the bank had already made their money, and whether she repaid them had already become someone else's problem. We investigate the hidden incentives behind the systems shaping your everyday life. Today's question is one of the most people have never thought to ask. What happens when a lender no longer needs you to succeed? If a bank lends you money and wants it back, they have every reason to make sure you can repay it. That's how people believe lending works. But that logic depends on one condition. The lender must still hold the loan when it fails. In the 1980s, Wall Street invented a way to remove that condition. And once the consequence was removed from the lender, the incentive to verify your ability to repay quietly disappeared. In 1919, General Motors had a problem. The assembly line made cars affordable to build, not to buy. Banks were reluctant to lend on something as new as an automobile. GM's solution was GMAC, the first dedicated auto financing company. Buy now, pay over time. For most of the 20th century, this worked because of one alignment. The bank held the loan. If you defaulted, the bank lost money. Their prosperity depended on your success. That alignment was the safety mechanism of the entire system. Then securitization removed it. In the 1980s, financial engineers began bundling loans into bonds and selling them to investors. Applied to auto loans, the process works like this. You sign, your loan is packed with thousands of others into a bond. The bond is sold to investors. The original lender collects an origination fee and transfers all default risk to whoever bought the bond. The lender has been paid before you've made a single payment. Now ask yourself honestly, if you've already collected your fee and transferred every risk, what incentive remains to verify the borrower can actually repay? We are not asking this theoretically. We found the answer in court documents. Santander Consumer USA was the largest subprime auto lender in the United States. Their loans typically carried interest rates in double digits, some as high as 29.99%. In 2019, Moody's analyzed one of Santander's bond packages and found that Santander had verified the income of its borrowers on just 3% of the loans bundled into those bonds. A competitor, GM Financial's AmeriCredit, verified income on 68%. Same regulatory environment, same technology available. One company checked, one didn't. That gap is not technical, it is structural. When you don't need the borrower to succeed, you stop checking whether they can. In 2015, a coalition of state attorneys general opened a formal investigation into Santander's lending practices. What they found is documented in a government complaint, and I want to be precise here because this language is exact. According to California's filing, Santander used sophisticated credit scoring models to forecast default risk. Those models identified categories of borrowers predicted to default at rates of greater than 70%. Santander approved those loans. Their own systems flagged 70% probability of failure. They approved, they packaged, they sold. Here is how the math worked once the loan was sold. One Santander bond package carried an average interest rate of 19% on its underlying loans. Some loans charged 29.99%. The bond was divided into layers. Senior investors were protected first. The structure was engineered to survive a majority of borrowers defaulting and still pay every bondholder. Santander issued $8.3 billion of these bonds in a single year, more than twice any other subprime lender. Every bond sold meant the consequences of those 70% default probability loans had transferred to investors. Santander had already collected their fees. Whatever happened to Janice after she signed was priced in. In 2020, 34 state attorneys general reached a settlement with Santander, $550 million in relief for consumers. Santander did not admit wrongdoing. Several executives named in the conduct later moved to Exeter Finance, another subprime auto lender operating inside the same incentive structure. A settlement resolves a legal liability. It cannot remove an incentive. What we are describing is not history. In 2024, 1.73 million vehicles were repossessed in the United States, a 43% increase from 2022. Subprime auto delinquency reached a record 6.9% in early 2026, the highest level recorded since tracking began in 1994. Nearly 31% of trade-ins today carry negative equity. People rolling underwater debt from one loan directly into the next one. The machine that generated Janice's loan is still running. It is running faster than it was when she signed. Janice eventually lost a truck. The remaining balance, what the repossession sale didn't cover, landed on her credit report. The credit report that the next lender will check. The credit report is scored by an algorithm she cannot see, produced by a company she has never heard of. Two systems, the same person paying for both. Here is the principle beneath this entire story. Whenever the person making a financial decision doesn't suffer the consequences of that decision, the incentive to make a responsible one disappears. The 2008 mortgage crisis was this mechanism applied to housing. What is happening in auto lending right now is this same mechanism applied to vehicles. Any financial system that allows consequences to be packed, sold, and transferred will eventually produce the same result. The product changes, the structure doesn't. The question to ask about any financial system you encounter is this: does the person who approved this loan still have something to lose if you can't repay it? If the answer is no, you now know what that means. This is the paradigm effect.